Welcome to Investing Insights. I'm your host, Margaret Giles. Exchange-traded fund launches have continued to accelerate, but not every shiny new strategy is worth owning. Good investment strategies can compensate investors with an appropriate return for the risks they take on. What kinds of ETFs are able to deliver over the long term, and which ones fall short? Dan Sotiroff is joining me today to explain the hidden risks in stock ETFs and what investors should look out for. Dan is a senior manager research analyst for Morningstar Research Services and the editor of Morningstar's ETFInvestor newsletter. All right, Dan, thanks for being here.
Thanks for having me.
All right, to get started, can you talk about the idea that ETFs should really be compensating investors for the risk that they take on? And what is an appropriate level of return?
Sure. Yeah. And we could extend this beyond ETFs. This is really like any investment, right? The way I think about it is it's really kind of hard to nail down precisely what an appropriate rate of return is. But if you think of it in like risk-adjusted return, like a Sharpe ratio where you're looking at a unit of risk or unit of return per unit of risk type thing. Let's say you're starting out with a broad market ETF like Vanguard Total Stock Market, right? If you're going to deviate from that total market ETF, you want to make sure that the risk that you're taking on is going to give you a commensurate level of return so that your risk-adjusted return should either stay the same or be higher than that Vanguard Total Stock Market ETF. So the next natural question is like, well, what's a compensated risk, right? So there's a really kind of basic framework I use. The first level is kind of like the strategic beta type risk. So they're going after investment styles like value, quality, low volatility, that sort of stuff, right? And you still need to do some due diligence on those to make sure they're actually capturing that factor and doing it correctly. The next level of risk would be like active stock selection from active managers. And again, you got to do some due diligence on those to make sure that the manager is reasonable, he's following a consistent process, selecting the right stocks and doing things appropriately. So those are like two basic forms of risks that can be compensated. At the other end of the spectrum, it's like what types of risk aren't going to be compensated. So it's like speculating on single stocks, trying to time the market. That's the type of stuff that you should just stay away from because it's very speculative and takes you away from sort of that long-term investment that we know really drives success over the long run.
Absolutely. So when looking at these risk and return profiles, and I'm going to talk about ETFs, but again, applies to other kinds of funds, the term active risk often comes up.
Yeah.
Can you give us a definition?
So yeah, it's actually pretty basic. Conceptually, it's just you're defining how different is my investment from like a benchmark portfolio. That's really all it is. Now, what that benchmark is could vary. We measure it in a few different ways. So tracking error, tracking difference. There's another one called active share out there, but they're all kind of conceptually getting at the same thing as defining how different is an ETF or a mutual fund from a benchmark index or a benchmark portfolio. That's all it really is at the end of the day.
All right. And again, I kind of think it's going to be a basic answer, but what kinds of funds have the lowest active risk?
Yeah, again, another really simple answer too, right? It's going to be the broad market index funds, right? By definition, they are sort of the benchmark that a lot of active managers are trying to outperform. They more or less represent the opportunity set that those active managers are picking from. So they're broadly diversified and the opportunity costs are really, really low. So those are going to have the lowest active risk, at the end of the day.
Gotcha. So investors really need to understand, are they tracking close to an index or are they perhaps veering off?
Right, exactly. So low active risk would be something that's very close to the index. Something that's higher active risk is something that's going to look very, very different from that benchmark index.
Got it. So can you talk about maybe an example of two ETFs that maybe on their face look like they have similar strategies, but they're actually taking on different levels of risk?
Yeah. So the first example that came to mind was, if we look at ETFs or mutual funds in the foreign large blend category, there's a lot of different ways you can build a portfolio of just, basic foreign stocks, and you don't have to get too creative with it. So one is iShares Core MSCI EFA ETF. The ticker is IEFA. And then you compare that to iShares Core MSCI Total International Stock ETF. The ticker is IXUS. Both are pursuing sort of broad foreign market exposure. So they hold stocks that are large, mid, and small caps, weight by market cap. The big difference is going to be how much they hold in emerging markets. That first ETF, IEFA, holds no emerging markets, whereas the more comprehensive IXUS holds emerging markets. So that part of their portfolios is not going to overlap at all. So you are going to see some active risk start to come into the picture. They will perform a little bit differently depending on how emerging markets are performing at any given point in time. So that's a basic example of what active risk can look like in practice.
Right. That's a good example too, because on their face, they sound really similar.
Yeah.
But
tracking the broader foreign market, do you include EM or not is kind of a big difference. So,
yeah. Absolutely. So you've written that any stock ETF with fewer than 100 holdings is a red flag. Can you talk about why that is?
Yeah, and just for context for the listeners, that was really around like dividend funds that I was talking about, right? And the problem with like high yield dividend ETFs is that as you reduce the number of holdings, you really get into a lot of like value traps and questionable stocks where the yield may not persist over the long run. It's not really as advertised. So I was using it in that context specifically around that. But the concept applies more broadly to any ETF. As you water down the number of holdings you get, you're going to be taking on more stock specific risk. That active risk is going to go up. So you're taking on more stock specific risk and you're taking on less of that risk factor risk that you really want. So when you're looking at some of these risk factors, you really want a broadly diversified portfolio of stocks with a common characteristic. You don't want stuff that's getting into the stock picking game. You want to leave that for the active managers that can provide a little bit more context around what is going on with the companies. Are these fundamentals real? Are they expected to persist in the long run? So yeah, leave that to the active stock pickers.
Okay. So I do want to talk about active versus passive a little bit. When it comes to more concentrated funds, does the management style make a difference? Are passive index tracking ETFs running into similar, potential pitfalls as maybe active managed
Yes.
funds?
So when you look at a lot of the index tracking stuff, some of the strategic beta stuff or the thematic stuff, they're using like some basic high level rules to pick stocks. And that's okay. The problem is, again, you're taking on a lot of that stock specific risk. There may be certain things that are about to happen or certain news events that are transpiring that an active manager can probably provide a little bit more context around. So, in general, stay away from those in the index tracking world. But yeah, the conversation absolutely changes when you go to active management. Those can be edges or sources of edge for an active manager if they can provide the right context and if they can adhere to a consistent style over time. So yeah, holding a more concentrated portfolio for an active manager isn't as much of a red flag in my opinion. But again, do your due diligence. You still need to make sure you've got a level-headed manager at the helm that's picking appropriate stocks and following a consistent process.
Absolutely. So I want to pivot a little bit and talk about thematic ETFs a little bit here. They're a popular example of those more concentrated portfolios,
Yep.
higher active risk. How have they performed?
Not well. And that's why I go back to like the previous question, like, it's probably something that you want to stay away from. But in all fairness, they come in mixes of both active and passive. So there is kind of a blend that you have to be aware of. But really what they're trying to do is they're kind of an of the moment investment. They're really trying to anchor to something that is popular at this point in time. Like you go back to 2020, we had work from home ETFs, right? Like, I mean, that's a great example. The thing with them is they don't perform well over the long run. So they can pop for maybe a year or two and look really, really attractive. The thing is that performance tends to fizzle out and they tend to fall from grace. And a lot of the flows come in right at the peak and then they crash. So investors tend to not get a very good experience. If you look at the 10 to 15 year horizons for a lot of these, a lot of them struggle to survive, let alone outperform just a broad global market portfolio. And again, the reason is because they're kind of the moment. Like the theme eventually is going to go away and the world's going to move on to something else. Like, right? Like we're not in work from home mode anymore. We're in sort of this hybrid work environment. So the world has changed. We've moved on. Themes eventually move on. And they're very short-term speculative investments at the end of the day.
Okay. Important to remember for investors. And it seems like I think you've already touched on this, but are investors missing their timing for these funds? They're really not capitalizing on the short term?
We've looked at it, and there's a lot of evidence that a lot of the money tends to flow in at the top right after they've had this huge run up in performance, and people are just really, they're kind of just chasing performance, for lack of a better term. The problem is they've seen all the upside. Now the downside is going to come. So they experience more downside than upside, and that's where it gets really bad. And that's not everyone. You certainly have sort of those early adopters that were really bought into the story and they got in early on and they saw some huge gains. So, but that isn't really like the common story that you hear. It's more the latter where they tend to get in at the top. So yeah, be careful.
Good takeaway there. So at Morningstar, we often talk about fees as a predictor of performance.
Mm-hmm.
Do you see the same thing here?
Yeah. I mean, from the perspective of that, thematic funds tend to be expensive and they tend to perform poorly over the long run. That's probably the biggest connection, right? But yeah, fees are really only part of it. Again, a lot of them are really sold on the narrative of what's happening in the moment, and that tends to be the bigger driver of performance. So you do have to be careful. But yeah, the fees are definitely a warning sign when you're getting into these things. They are often multiple times more expensive than some of the simple broad market index funds that you would want to be using as the core holding in your portfolio, let's say.
Right. And it seems like maybe there's a difference between active and passive in this scenario, but should investors always choose a fund that takes on kind of that more predictable risk? Or are there cases where maybe higher active risk is really worth it?
Yeah, as a general rule, I think you do want to anchor to something that has predictable. You want to understand how it's going to perform in various market environments. Let's put it that way, and that's what we mean by predictable. Not that it's going to shoot to the moon or something like that. We want to know how it's going to perform in up markets and down markets, or maybe other various economic scenarios like high inflation, low inflation, that type of stuff. So if you understand those types of things, when those events come along, you're more likely to say, well, I expected it to underperform in this environment. It's doing what it's doing. That works for me, right? It's going to help you stay invested for the long run. High active risk stuff can work because, again, those styles still apply. So you can see, a higher active risk portfolio kind of ebb and flow with inflation or the economic cycle or however it may flow. That's fine, so long as it's doing that. When you get into like the active manager stuff, again, you want to make sure that they're following a predictable process and that makes sense and that they're consistently picking the same types of stocks over and over again. The actual names may vary, but the thesis behind what they're doing is the same. So they're following the same style consistently is really kind of the hallmark that you're looking for.
All right. So lastly, what is one takeaway you have for investors that are trying to choose an equity ETF?
Yeah, really simple. Like your default option should be like a low cost total market fund. Start there, right? It has the least opportunity cost in it. Anything you want to do beyond that, you need to make sure that active risk is going to be compensated in some way, shape, or form, like we started out talking about, right? It's really that simple.
Yeah. Do the due diligence, understand what your funds are doing, right?
Yeah. It all goes back to the basics at the end of the day.
All right. Dan, this is really helpful. Thanks for taking the time.
You're welcome. Thank you.
That wraps up this week's episode. A couple of reminders. Give Investing Insights 5 stars on Apple Podcasts to help others find the work we're producing for you. And subscribe to Morningstar's YouTube channel to watch new videos from our team. Thanks to senior video producer Jake Van Kersen, lead multimedia editor Ivana Hampton, and associate multimedia editor Jessica Bevel. I'm Margaret Giles, senior content development editor at Morningstar. Thanks for tuning in.